Did you find that private equity firms in general were prepared for some sort of economic downturn or recession?
Absolutely, Lisa. I mean, they've been preparing for a while now. As you mentioned, the industry has been maturing, been growing, but they've also brought forth the lessons that they learned from the last financial crisis. I think everything they've bought in the last couple of years has been going through recession cases and scenarios so they can plan accordingly. They've been very deliberate about which sectors to invest in, things that look more resilient, they say technology, business services, et cetera. One of the big changes over the last few years has been the increase in operating resources, value creation teams. These firms have roughly 30% more resources on the ground than they did even just 5 years ago. Liquidity levels, they have leverage levels that are more resilient and covenants that are not too tight. And I think all in all, they recognize that in the last financial crisis, they were too passive on the investment side and that they missed opportunities to really bring capital into the equation.
All right, well, that brings us right to today. There certainly are companies where people are saying that there should be some sort of investment made, given the fact that we're seeing some dislocations and we've got companies saying that they might run out of cash if the slowdown due to the coronavirus persists. How many of these big private equity firms are stepping in and saying, we got your back?
Oh, I think they've been in some ways waiting for this moment to step in and provide capital. You know, when you look at even smaller companies out there, this is what they've been investing behind for a few years. They've isolated the sectors that they want to play in, and to some degree, they bring the capital. In many different forms from an equity perspective, but also they've been raising these credit funds that can provide either short-term liquidity or just the ability to get deals done. But they really also provide the expertise and the know-how. Again, these value creation teams can be super helpful in these slowdowns and these periods of disruption, thinking through how do you chase growth, how do you operate more efficiently, how do you think you have sort of the right liquidity levels, et cetera. So they're in a great position to come in and really provide capital and expertise and know-how.
Andres, can you square this for me? Because I speak with economists all the time and investors who say that there are a lot of small and medium-sized businesses that are going to have a real issue over the next couple months if this coronavirus-induced slowdown persists. You've got the government saying we've got to extend loans, but you're saying there are all these companies that are flush with cash just waiting to lend to all of these small companies in a position of weakness right now and give them expertise. Is there no problem? Is there the gap and the money to fill the void?
Well, I think it's across the system. First of all, I think they will look at companies that are performing well, and in this environment, they're going to be able to make those investments at probably more reasonable valuations that they have in the past. And I think they are looking at companies that may be under more stress and saying, how can we come in and provide stability? And they've certainly raised the funds to be able to make those moves. I mean, I think right now they're at roughly $2.5 trillion in terms of dry powder. And again, if the lessons are true from the last recession, this is where they can make really, really good investments. The other thing that we've seen was from the last recession as well, companies that were private equity owned back then spent more on CapEx than companies that were not private equity owned. So we know there's a willingness to come in and really make a move. When you have these disruptive times, it is an opportunity to gain market share. It's an opportunity for interesting business combinations. And I think private equity has been thinking about this a lot. Now, I would say they've been thinking about the slowdown and preparing for it generically. If COVID-19 is indeed the trigger that pulls us into the slowdown, certain sectors are going to get disproportionately affected, both to the good and to the bad. And so there's some near-term reallocations that need to happen in terms of where the targets are and how private equity wants to play.
Just real quick, 20 seconds. Do you have a sense that there are a number of private equity firms that might get hit pretty hard by the slowdown?
I think no one is immune from this slowdown, but I do think the industry is much better prepared than they were 10 years ago.